Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello and welcome to LiveSquawk's preview show. You're joining me today for ECB interest rate preview, and we'll be joined by LiveSquawk's European editor, Eric Culp, and by special guest, Gunter Grimm. For those new to LiveSquawk, we are a news aggregator service, audio news channel. You can go to our website and take a trial and see if we can help you in your trading day. We bring you news live 24 hours a day, effectively, on anything that moves the financial markets. So give us a try if you haven't already. And welcome to today's show. 2 in 1 week, actually. We did a preview show for the FOMC yesterday, but we'll review some of that. But today, we are looking at the ECB and really just previewing what to expect from the rate decision itself, and then also from really just what we can expect from the press conference, other than a snooze fest, which is normally what it is. Hopefully, I'm building it up. This is going to be interesting this time around. Just to introduce my guest, and as I said, Eric Culp is our European editor based in Frankfurt and has covered the central bank, the ECB, particularly for a number of years for LiveSquawk and beyond. And Gunter is an economist by training and is currently on gardening leave. He speaks in his own capacity, to make that clear. He has over 25 years of experience in the financial industry and has held positions as a portfolio manager, salesperson, and currency strategist. And you can find him on LinkedIn, as well as on X, and I'll put out the details later. So before we go any further, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. LiveSquawk is not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to say hello to my two guests. Hi, guys.
Howdy.
Hello, everyone. Thanks for having me.
Right, so you might detect a twang, an American twang, from Eric. He's how long have you lived in Frankfurt now?
Longer than I lived in the United States.
There you go.
Yeah.
You kept it. You kept it strong, though. I like the accent. Kept it very strong.
Well, so it's you never know what you're going to need nowadays.
And yes, and to Gunter, thank you for coming on today's show. Right, before we get any further, just to give you, and Gunter's provided his own sort of research on this as well, but I just want to give you a bit of a heads up as to what we're expecting. So the rate decision itself is due at 13:15 GMT today. Consensus is that we're going to get a 25 basis point cut, which will take the main rate we look at down to 3%. Note by Barclays expects the ECB to cut all three key rates by 25 basis points, but suggested that the Governing Council will refrain from providing much guidance on future policy decisions. We expect the policy statement to reiterate the Governing Council's confidence that disinflation process remains well on track, but to continue to highlight downside risks to the growth outlook, particularly in view of the policy agenda of the new US administration. The Governing Council will continue to assess the policy stance as restrictive. We expect the ECB to continue its data dependency and meeting-by-meeting approach. This strategy enables the GC or Governing Council to maintain flexibility and adjust policy gradually and smoothly under alternative scenarios. That was Barclays' view. Is that something, Eric? I mean, you've written a preview for today's event. What do you see, and what do you expect from today's decision?
Yeah, I think 25 basis points. Pretty much everybody out there is betting on that. I think, you talk about a snooze fest, highly possible. I think right now everybody's watching to see what the United States is going to do, and that being, of course, President Donald Trump. The question is, does anyone want to poke that bear right now? Probably not. You saw what happened with Colombia. Quick reaction when the administration in Bogota said, "Nah, you can't fly those migrants back to the country, military planes." And Trump said, "Okay, 25% tariffs immediately, emergency tariffs." That said, I don't think Lagarde, she doesn't shy away from controversy. In fact, I think she kind of courts it. So maybe I presume that someone's going to ask the question, hey, is this enough right now? If you look at what happened earlier, within the past hour and change, the Eurozone GDP number came out flat, which was lower than expected. The German economy contracted more than expected last quarter, and France contracted, and no one expected that. Italy showed flat growth. Basically, across the main three biggest economies in the Eurozone, there's nothing happening. And Spain at 0.8% last quarter. Yeah, okay, they're doing okay, but that's not
surprise. It was a surprise, wasn't it?
Yeah, it was more than expected. But they're not going to be able to carry the Eurozone. That combined with high energy costs right now, I think it looks like inflation is going to hold low enough that the European Central Bank can say, "Yeah, you know what? Let's cut some more rates." I don't think there's going to be a preemptive today, but it wouldn't surprise me if they went further. I know that sounds crazy, but times are a little crazy right now.
Preemptive? You think they go preemptive on this maybe?
Well, maybe go bigger. I don't think it's going to happen. I think it's a 25 basis point, but if they went 50, would anybody really be surprised? I don't think so. They have terrible growth right now. It doesn't look like it's going to get any better. And, Trump is breathing down their neck saying, yeah, guess what? I'm going to put tariffs on you.
Yeah. So that makes a good case. Gunther, do you agree with that? Do you have a counter to Eric's sort of, expectations?
Yeah, I'm afraid I can't spice it up. I agree with Eric. We've spoken quite a few times before, and you know that I'm relatively negative on the Eurozone for structural reasons. And that remains my main view. So, yeah, as Eric said, 25 is expected. Thereafter, around 100 basis points in total with today's move are expected until the end of the year. I think it's very likely, if anything, I think the risk is to further downside there in the rate path. And the reasons are also a bit more structural. And now, of course, with Trump winning as a president and with his agenda, I think the risk is that the Eurozone as a whole will fall further behind the US. So if you look at the issues, they're facing tariffs, as Eric says. Maybe the silver lining is the Europeans buy more LNG to head that off. I don't know how likely that is, how much more they can buy, or if there are other areas where they can try to reduce the trade deficit. But ideally, Trump wants European companies to invest in the US and not just export to the US. So from that perspective, I can't see FDI going in the Eurozone's direction, but rather into the US. You have political uncertainty, especially in Germany. People say, yes, we will get it. I'm German, by the way, you might tell that by my accent. But we have a new government led by the conservatives, but it will be a coalition, probably with the Social Democrats or the Greens. And I think it will be more of the same, but not like a Trump-like response. So I remain negative on that front as well. There's way too much regulation, and I can't see the Europeans doing the same as we will witness, in my view, in the US. There's also no innovation, rather regulation. Demographics are uncomfortable, and taxes are too high. Therefore,
I'm starting to cry now with all this.
Yeah, me too. I need a tissue, I think.
But to be fair, it's also now the consensus. So Germany is a segment of Europe. One has to be careful before one gets too carried away with this view. But yeah, to sum it up, I think there's more room to cut for the ECB. And then we have to also see what Trump has in mind with regard to tariffs, how the euro will then respond.
On that front, and we're not a political show, but just in terms of Trump, do you think because of the current state for the two biggest economies within the Eurozone anyway, and the leadership issues they've got at the moment, that no one in a better situation with a better German situation, they'd stand up to Trump? Or is this simply a case of just economics 101? We need America more than America needs the Europe, for example, and that's just the way it is. Eric, would you go with that at the moment?
Yeah, that's an interesting point. I don't know if Friedrich Merz, the head of the CDU, which he's the chancellor apparent right now, unless the polls change radically before the election. I don't know if he's got that kind of pushback in him. I mean, he's can be vociferous sometimes and boisterous. I don't know, he's got that attitude. I don't know. And I really don't know enough about French politics right now to see who would step forward. And I think this is also, they would have to support the EU. You'd like to think that they would. Germany's still kind of caught in its shadow of what it did, during the Nazi regime. I don't know, though. The economy is really an issue right now. I think Gunter made a good point about buying U.S. LNG. With gas prices, they're pretty high right now. I think I saw a headline recently about how high they are. And if you want to make the United States in the form of President Donald Trump happy, you appease. And buying more LNG might do that. As per whether or not the Europeans can stick together enough right now to push back on the U.S., it's hard to tell.
Yeah, Gunther?
Yeah, Eric mentioned a good point. There's no unity in the Eurozone at the moment. You don't know who to speak to. Von der Leyen, I think she's a weak leader, doesn't have a political backing, I think, because she's not democratically elected. And I think Trump also wants to, cause a bit of problems for the Eurozone in the sense that he doesn't like the whole concept of the Eurozone, and I don't think he likes Europe. So maybe he will then try to negotiate with leaders like Meloni in Italy and maybe in Merz in Germany, in France. You don't know really who to talk to and how that will change. So it's not a great starting point for the Eurozone, I think.
So, okay, so we're looking at a glum picture. So we widen this out now to say even the first half of this year. Do you see, we're looking for more cuts down the line then, and this, I wouldn't call it a race to the bottom, but an issue for the Europeans that they'll want to try and get ahead of the curve, so to speak, with the problems they've got. As Eric suggested, they could even take that step to, it wouldn't be beyond the realms for them to go 50 today maybe, or to at least message a more dovish stance than we've had before. Again, if you, Gunther.
Yeah, I think the ECB is inherently dovish, and I always say half jokingly, but also half seriously. The ECB has two mandates. One is price stability, and the second one is to keep the Eurozone together. We've seen that during the great financial crisis. And given the problems the Eurozone faces, in my view, it's not an optimal currency area, and we can talk about hours about that, why that is. But I think it's not, and therefore the ECB has to kind of hold it together. It starts with the bond market, with the local bond markets, and sorry, the phone is ringing. And therefore they have a tough job at hand, and it will be dovish.
Okay, I'll let you get the phone quickly. But just in terms of, I've got an ING piece here that says Eurozone's growth stalls as policymakers show sense of urgency, and they don't expect any immediate pickup in the weakness that they've seen, as they believe it remains widespread, and the outlook for them is sluggish. So again, I don't think there's a lot of people out there really overly enthused about the outlook for the European economy as a whole, and I guess that gives an upper hand to the incoming administration now, the Trump administration, in terms of his ability. And I don't want to use the word bully, because is trade. This is about trade and doing the best for your country. But in terms of he has the upper hand and all the leverage, I guess, at the moment in terms of the trade element. Also with the pressure from Asia and from China particularly in terms of the auto sector and EVs that's besieging the likes of BMW or maybe less BMW, but likes of the large German sort of car makers. I want to start looking now a bit more. Then we've covered the growth to a degree. I want to turn to the US and to take a look firstly at last night's FOMC decision, and then we've got GDP data coming up today as well, which is that we think will slow, I think, to 2.7 from 3.1%. Gunther, what are your views on last night's decision and with the health of the US economy in that respect?
Yeah, thanks. Yeah, it was an interesting one. Everybody was expecting a kind of a snooze fest, but it turned out to be a bit volatile, and the reason for that is also a bit strange. So basically, they changed the inflation language a bit, and that led to a bit of a sell-off in bonds, yields higher, stocks suffered. But then he toned that down. But in after all, I think it was slightly more hawkish than the market was expecting. I think they are also in the dark as everybody else is. I mean, at least personally, I don't know what happens to the new policies from Trump. Will it be inflationary? Will it be stagflationary? What I noticed, though, is, and maybe Harry, you can share the chart, that after Trump's election, basically, you saw. I can show it here maybe quickly.
If you want to share your screen.
Yeah, I share my screen now. So we saw in the US after Trump's election victory, we saw an increase in real rates, but then, and then we saw a decline in real yields, which was, here it is.
Yeah.
So in the upper panel, we see real yields derived by TIPS, Treasury Inflation Protected Securities, different maturities from 2 to 10 years. And in the lower panel, we have inflation expectations.
Right.
So from November onwards, when Trump was elected, we saw an increase in real yields in general, but then now a decline, especially at the short end. And that the reason behind that, of course, is inflation expectations have increased at the short end. And that struck me when I updated these charts. And I was wondering, why is that? Trump wins, you would have maybe thought real growth expectations should increase given tax cuts and deregulation and what have you. But the market seems to take, at least in the short term, the opposite view. It has lowered real rates and increased inflation expectations. So this, to me, at face value, would suggest more like a stagflationary environment. And also what I notice is that the 10s yield curve, so 10-year yields minus 2-year yields, they flattened again. We've seen a pretty sharp steepening in the last couple of weeks, months, but now that has reversed a bit.
Just to explain to the audience, that is generally a good indication of the market's perception of growth and the health of the US economy.
Yeah, exactly.
Right. So just looking a bit, I guess, at the broader, again, you have other sort of material there as well. But looking then towards staying with the US and the health of the US, we'll have PCE data today. That's the quarterly look, but we want to look at again Friday's PCE data, and particularly the PCE deflator core PCE. What are your views in terms of what we're likely to see on that front in terms of inflation?
So I don't have my own model. I just read a lot, and the Fed watcher Nick Timmermans, what he does is he compiles the forecasts. And
yeah, I saw this yesterday.
The PCE one is an easier one to forecast. you're quantitatively driven because you have the CPI already and import prices and the PPI, and from that you can derive most of the PCE components and come up with this forecast. So I would expect not a big surprise tomorrow. So according to his calculations, he expects a month-on-month increase of 0.18%. That gives annualized 2.2. 0.17 would be the rate Waller mentioned. That would get you to 2%. And PCE, just as a reminder, is the measure the Fed follows. So it would get us close to 2%, but of course the Fed wants to see a few more of these kind of prints, ideally. But looking more forward, I see up and downside risks, of course, as every economist, a two-handed economist would say. On the downside, I do expect, if it wasn't for tariffs and Trump, I would expect the labor market to soften because I think the economy is slowing down a bit. This AI revolution should be deflationary.
Isn't that an embedded? Isn't that a longer term situation? I mean,
yeah, but something I think the Fed should look at. But you're right; it's more longer term, correct? But this deregulation could have an impact, I think, also in the short term, especially also on the energy side. I don't know how he wants to pull it off, but Trump talks about lower oil prices, and there was an interesting article in Bloomberg. Javier Blas, he's quite good. He suggested that maybe OPEC could increase or actually follow its original plan to increase supply in April, and then you could maybe see oil prices falling. That would help a lot to think about it, also from the Fed's perspective.
Yeah, but
rental inflation.
This is a self-serving body. So would you see OPEC kowtowing to President Trump so quickly?
Well, I don't know what the deal could look like, maybe security guarantees and what have you, but I wouldn't rule it out, knowing Trump.
Yeah. You can't count anything out, can you?
No. And it changes every day.
Yeah.
And you have, of course, rental inflation. If you look at forward-looking measures, rental inflation seems to be cooling down. And given the lags in computing the OER, that should lead then also to lower rental inflation. On the upside, of course, we have the whole discussion about tariffs, but there again, people are divided. Is it inflationary? Is it not inflationary? How are the tariffs structured? Are they phased in? Are they one-off? And then how will the Fed react? You could argue the Fed could see it just as a one-off and look through it. Others say, well, given that inflation expectations are already on the high side, if you then don't react as a central bank, you would then therefore manifest these higher inflation expectations and end up with higher inflation overall going forward. So that's the risk. But to be honest, I don't have a strong view what he will do. I take it day by day, really.
Which is the most sensible thing to do. I want to go back to the ECB because I want to turn to the last part of our chat today. I want to go back to the full guidance then and what we're looking at. I know you've got a look at, let me get your, you've got some ECB expectations and what's priced in for later in the year. And we'll come to that in a second. But Eric, in terms of the presser, what are you expecting? You said it might be a bit more interesting than normal because of today's developments and today's data. What are you expecting Lagarde to sort of come to the table with in terms of guidance today?
Well, it'll be interesting to see whether or not she's willing to talk about growth. Growth is a problem, and most of the estimates you see, people are cranking them down, right? It's not like everybody's going to say, growth's going to be better this year. No, it's not. It's going to be worse, especially the German government came out, was it yesterday, and said that if they slashed it for this year and cut it for next year. It's to low numbers. Germany is the biggest economy in the Eurozone, and it needs help. Now, the question is, I've been thinking about this when we were talking about some of these things, are lower rates really going to help? That's, I think, is the big question that everybody's probably asking themselves. But the European Central Bank, they can't really do anything but cut rates.
That's the only tool they have to their.
That's it. That's all they can really do,
Right.
at least at the moment. And I think because I'm sure Lagarde causes really headaches within the European Central Bank Governing Council because she'll go right off script. And we see it all the time. We all kind of scratch our heads because the bank is trying to send one message, then she sends something else, and then there's a bunch of backtracking, and oh well, it's actually here's what she meant. And they don't provide forward guidance until she says something that is perceived as forward guidance. Are they going to go with data dependency? Probably. I don't think they really want to pick a fight with America, or at least with the Trump administration about, we don't care about tariffs, or we can handle it, or anything in that direction. But, journalists, it's our job to prod people, right? So she might take the bait and talk a little bit about. I think they have no choice but to go more dovish, considering the data that just came out, the expectations, and the possibility, even the threat of tariffs. I think it's already hurting business confidence in Germany, probably throughout the European Union. People are saying, oh, Christ, what now? What's this going to be, 25% tariff on our goods? It's going to kill us. So I don't think she can ignore it, and that may open up a discussion about how the European Union in general has to react to this. And, she's probably going to talk about national finances and whether or not, the Draghi plan, if that needs to be put into place. It's not really something she can push, though. She can only toot that horn. She doesn't lead the band.
Sure. And Gunther, I know you've been looking at the rate expectations there. I know you've got a chart. What are your views on what the market's going to do and how? I mean, no one knows. I mean, how the market would. How would you respond to having seen today's growth data? I think you had a chart of the. I'll turn it on. That's it. Just of the ECB. Let me see if I can find it. Where is it? If I can turn you on, and that's it. There we are. There we go. So your expectations for interest rates throughout the course of this year, or the market implication for rates?
Yeah, I agree with Eric. The growth risks are certainly on the downside. I guess she will also be asked regarding tariffs and how the ECB might respond. And Lane's comment was quite interesting. He's the chief economist at the ECB, and he suggests that the impact on growth could be of more concern than the impact to inflation via higher tariffs. And that would be also my view. I think the ECB will err on the dovish side. So this rate path you're seeing there, the implied rate more on the right-hand side, I think could easily drop to below 2% over the course of next year.
Okay, so again, continuation from the Fed as we see from the ECB as we see the Fed again potentially on hold for a lot of the year, and you look around, and we won't go into the UK at the moment because that's got its own set of problems as well. But again, just to back up that point, Villeroy here in a recent says that there's plausible consensus that we will go on acting at each meeting, which we have successfully practiced since September. So in terms of the dovishness, just to finish up now, we're looking for 25 basis point cut. We're looking for potentially a dovish sounding Lagarde, really, and an outlier would be they go in a little bit harder on the rate cuts and signal, if not do, that we are looking at a deeper cycle of rate cuts for the Eurozone based on the fact that there is stunted growth to no growth at the moment in the region. That makes sense?
Absolutely fair, yeah.
Yeah.
It should come from.
I'm sorry, Gunther?
You wonder where the growth impetus or shock should come from, apart from lower interest rates. But as Eric also mentioned, they won't do the trick.
No,
Yeah,
Eric?
I'm with you. I think they're going to have to go harder. I think the market's already adjusting to that. After the GDP data today, you're seeing people say, "Yeah, this is probably not going to be enough." Capital Economics, in their flash comment right after the GDP number, they suggested, "Yeah, what's in the market now? Probably not enough."
Right. Fair enough. And on that note, we will leave it. But thank you guys for your input. Always appreciated. And Gunther, I'll put out your details for anyone who wants to get in all your sage words. And Eric, we'll wait your write-up following today's press conference of the ECB rate decision. But thank you both for coming on the show. Guys, everyone else, thank you for listening. Good luck today. The interest rate announcement is coming up again in a couple of hours' time, and the press conference was it half hour later. So just keep an ear out for that. And in between that, we've got US GDP data to contend with as well. So enough for those intraday traders to get their teeth into and trade around. So good luck, and thank you again for listening. We'll see you on the next one.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.